We already discussed in our previous class that accounting is an art of recording, classifying, summarizing, and interpreting business transactions in a systematic manner. The fundamental objective of accounting is to show a clear picture of the operating results and financial position of the business. As a result of technological, economic, and industrial developments, various specialized and niche markets of accounting have emerged. In this video, we will go through the basic branches of accounting to define and differentiate what each is all about. So, dear friends, welcome to a new video of ComArt. Let me introduce the topic. Accounting is the art and science of recording business transactions in a systematic manner. It is often referred to as the language of business because it has to provide various types of accounting information to different internal and external stakeholders such as owners, investors, debtors, creditors, government, general public, and so on. The information requirement of the stakeholders is different based on the purpose for which it is used. Different branches of accounting came into existence, keeping in view various types of accounting information needed by different classes of stakeholders. There are four main branches of accounting, namely bookkeeping, financial accounting, cost accounting, and management accounting. There are some other branches of accounting also. They are emerged as a result of economic and commercial development and emerging needs of business reporting all over the world. The first branch and basic form of accounting is bookkeeping. Bookkeeping is the process of recording business transactions and financial information made by a business firm on a day to day basis. Its main purpose is to ensure that the records of all business transactions are correct, up to date, and comprehensive. In bookkeeping, each transaction is recorded on the basis of supporting documents such as receipt, invoice, purchase order, etc. The book of account used to record bookkeeping transaction is called as journal. As bookkeeping records financial transactions on a day-to-day basis in journal, it is often considered as routine and clerical in nature. J.R. Badleyboy defines bookkeeping as an art of recording business transactions in a set of books. As per this definition, bookkeeping differs from accounting. The main difference is that bookkeeping is a distinct process of recording business transactions that occurs within the broader scope of accounting. Other differences between bookkeeping and accounting will be discussed in later sections. Bookkeeping has some unique characteristics. Recording financial transaction is the first feature. Bookkeeping records financial transactions and information on a day-to-day basis in a book called journal. The second feature is posting debits and credits. While recording financial transaction, it has to identify the debit and credit aspects of each transaction and to organize them systematically. The third feature of bookkeeping is producing invoices. Each transaction is to be recorded only after producing some supporting documents such as invoices. The fourth feature of bookkeeping is that in addition to recording financial transactions in journal, it has to maintain some subsidiary journals and general ledgers and balances them from time to time. The last characteristics of bookkeeping is that it has to deal with the preparation of payroll records also. Payroll refers to the sum total of all financial records of salaries, wages, allowances, and deductions. Another branch of accounting is financial accounting. Financial accounting is the original form of accounting because it involves the process of generating financial statements which is published for catering the needs of all stakeholders including general public. Hence, it is also termed as general purpose accounting. Now we can see the meaning of financial accounting. Financial accounting is a specific branch of accounting which involves the process of recording, classifying, summarizing, and interpreting business transactions. The basic purpose of financial accounting is to prepare financial statements that companies use to show their operating performance and financial position to the people outside the company. The important financial statements prepared by the company for this purpose include the income statement and the balance sheet. For understanding the meaning of accounting from a technical aspect, we can examine the definition given by AICPA. According to AICPA, accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money, transaction, and events which are in part at least of a financial character and interpreting the result thereof. This definition lists out the functions of accounting as recording, classifying, summarizing, and interpreting business transactions. Now, let's discuss the essential features of financial accounting. First of all, accounting is the art of recording transactions. Only business related transactions which can be measured in monetary terms are to be recorded. Both journal and subsidiary books are used for this. Classification of recorded transaction is a main feature of accounting. Accounting makes group of all similar entries in one place. For example, all receipts and payments are shown in cash book. So all transactions are collected under common head. This process of classification is completed by opening separate accounts in the books. These books are called ledger. Next feature is summarizing. Summarizing is the art of showing business results in condensed form. This feature tells about the preparation of financial statements such as income statement and balance sheet. By interpreting, one can know whether the position of the business is good or bad. By knowing this, we can arrive at the intellectual decisions. Communicating is the distinguished feature of accounting. Accounting results regarding the operating performance and financial position which are available in the financial statements are to be supplied to the various stakeholders including people outside the company. Cost accounting is one of the important branches of accounting. Cost accounting as a branch of accounting is considered to be a type of management accounting used internally to assess the operations of a manufacturing industry. Cost accounting deals with evaluating the cost of a product manufactured or services rendered. It refers to recording, summarizing, and analysis of manufacturing costs by following a quantitative approach. It calculates cost of products by considering all factors including manufacturing and administrative that contribute to the output production. The main objective of cost accounting is to help the management in fixing prices and controlling the cost of production. For this, cost accounting separates cost into fixed and variable cost and looks at how they affect business and hence how these costs can be better managed. By focusing on cost control and management, it helps in improving the efficiency of business processes and thereby maximizing profits. In short, a well established cost accounting system is very much essential for every business enterprises to have a proper cost control, pricing decision, and improved business efficiency. All these objectives and benefits are properly considered by the Chartered Institute of Management Accountants while defining cost accountancy. According to CIMA, cost accountancy is the application of costing and cost accounting principles, methods, and techniques to the science, art, and practice of cost control and ascertainment of profitability, as well as the presentation of information for the purpose of managerial decision making. Since cost accounting is a separate type of management accounting, it has some distinct characteristics. Cost accounting guides management with regards to determining the selling price of the products and services. It is also helpful for preparing tender and quotations. Cost accounting helps the management in attaining the important objective of controlling cost. For this, various techniques such as budgetary control, standard costing, and inventory control are applied. Controlling cost is the sole practice of increasing the efficiency of business operations. Management has to take and implement apt decisions at right time. Cost accounting supplies accurate information regarding total cost and per unit cost to the management at the right time so that it may be helpful in decision making. Cost accounting helps in ascertaining the costing profit or loss of each product, process, job, or operation rendered on an objective basis by matching cost with revenue of the activity. For this purpose, a statement of costing profit and loss is to be prepared. To operate the business at high efficiency, it is essential for the management to have financial and other statements at the short intervals. Cost accounting provides daily, weekly, or monthly statements of units produced, accumulated cost with analysis. Management accounting is another important branch of accounting. It is a combination of two words, management and accounting. So, management accounting is a branch of accounting which provides accounting data to the management for making decisions about the operations of a business. In other words, management accounting is focused on analyzing financial data to prepare internal financial reports and records that helps the managers of different departments in the process of decision making. In management accounting, what do the managers should have to do is making decisions efficiently with the help of various management information systems such as budgetary control, projected cash flow and fund flow statements, cost volume profit analysis reports, break-even point calculation, and so on. All these statements and reports will not be disclosed or published to the external stakeholders. Instead, these are utilized by the management to improve the core business processes. The report of Anglo-American Council of Productivity defines management accounting as the presentation of accounting information in such a way as to assist the management in creation of policy and the day-to-day operations of an undertaking. Management accounting is basically different from financial accounting in the ground that it serves the needs of the management in decision making with regards to minimizing the cost factor and enhancing profit making. On the other hand, financial accounting serves the needs of shareholders, creditors, and other external stakeholders in order to ascertain the operating performance and the financial position of the business. Other differences between these two will be discussed in the later section of this video. Management accounting has some specific features such as management accounting uses the information provided by financial accounting. Management accounting selects only few information that are actually required by it. The main aim of management accounting is to ensure managerial decision making. This objective of management accounting is attained by presenting various information collected from financial accounting in different basis and in different manner. Financial accounting shows the actual amount of profit earned or loss suffered by the firm during a particular period. It fails in discussing the reasons for the actual aim of profit or loss. This limitation of financial accounting is rectified by the management by studying the cause and effect relationship existing between variables which affect business activity and profitability through various analysis. Management accounting makes use of some special techniques and concepts such as ratio analysis, break-even analysis, comparative statements, etc. in order to help management in decision making. Management accounting modifies, analyzes, and interprets financial data with the help of these techniques in assisting management to take the line of action towards the control of destiny of an undertaking. In addition to the financial data available in the financial statements, which are purely quantitative in nature, management accounting considers some qualitative information relating to efficiency of employees, labor turnover, organizational culture, market conditions, consumer behavior, and so on. It considers both quantitative and qualitative information as valuable. Management accounting makes use of various techniques and concepts from several academic disciplines and professional specializations in approaching managerial problems. It takes contributions from mathematics, marketing, finance, and so on. Management accounting does not give priority for collecting and dealing with historical data. It attempts to highlight upon what should have been. In this aspect, the use of standard costing, cost variances, budgetary control, and so on emphasizes to highlight upon the futuristic nature of management accounting. Financial accounting system has to follow specific rules and forms while recording business transactions in the books of accounts. But there is no such rules and forms to the management accounting. Moreover, the tools and techniques applied by the management are varying from one period to another and from one firm to another. Management accounting always attempts to solve managerial problems. It takes into account a comparative analysis of various available alternatives that ultimately intended to assist management taking fruitful decisions. Now we can move on to the next area. Here we are going to differentiate bookkeeping, cost accounting, and management accounting from the financial accounting. First of all, we can examine the differences between financial accounting and bookkeeping. As we already pointed out, there are some differences between bookkeeping and financial accounting. Important among them are: first differences lies in the definition of these two. Financial accounting can be defined as the art of recording, classifying, summarizing, and interpreting business transactions, whereas bookkeeping can be defined as the art of recording business transactions. From the definition, it is clear that financial accounting is a process of summarizing, interpreting, and communicating business transactions which are classified in the ledger accounts, whereas bookkeeping is of mainly related with identifying, measuring, and recording business transactions. So we can say that the financial accounting has wider scope, whereas bookkeeping has only limited scope. Financial accounting is acknowledged to be practiced as a profession. On contrary to this, bookkeeping is characterized as the actual application of recording transactions. That means financial accounting professes, whereas bookkeeping practices. The objective of financial accounting is to gauge the financial situation and further communicate the information to the relevant stakeholders. Whereas bookkeeping aims to keep the record of all financial transactions in a systematic manner. Thus, financial accounting is more complex in nature compared to bookkeeping, which is clerical and repetitive in nature. Next difference relates to the skills required by the persons doing accounting and bookkeeping jobs. Accounting requires special skills due to its analytical and complex nature, but bookkeeping does not require any special skill sets. The last difference is that the person doing accounting works are came to known as accountants, who should require sufficient experience and education. The person doing bookkeeping works are known as bookkeepers or accounts clerk, whom are required to be accurate in their work and knowledgeable about financial topics. The works of the bookkeepers are usually overseen by an accountant. Financial accounting is an accounting system which is concerned with recording of financial data in order to exhibit exact position of the business. On the other hand, cost accounting refers to that branch of accounting which deals with cost incurred in the production of unit of an organization. There is no comparison between these two because they are equally important for the users. Now, we can discuss the differences between financial accounting and cost accounting. First difference between financial accounting and cost accounting pertains to the main aim of these two specific branches of accounting. Financial accounting aims at safeguarding the interest of the stakeholders. As against this, cost accounting aims to provide information to the stakeholders. Second difference is that financial accounting is mandatory to all firms, whereas cost accounting is adopted on voluntary basis. Next difference is that financial accounting emphasizes the measurement of profitability, whereas cost accounting emphasizes ascertainment of cost for controlling and reducing purposes. Next difference relates to the disclosure of net profit or net loss. Financial accounting discloses net profit or loss of the business as a whole, but cost accounting discloses net profit or loss of each product or job separately. In the case of financial accounting, the transactions to be dealt should be accurate. On the other hand, in some special cases, cost accounting uses appropriate figures also. There is difference with regards to the type of cost used for recording in both of these types of accounting. Financial accounting records historical cost only, whereas cost accounting records both historical and predetermined cost. In financial accounting, costs are reported in aggregate. On the other hand, cost accounting breaks down the cost into different units such as material cost, labor cost, overhead cost, manufacturing cost, etc. The last difference between these two branches of accounting pertains to the reporting time. Financial accounting is reported mostly at the end of an accounting period. On contrary to this, cost accounting is frequently prepared and monitored accordingly. Finally, we can discuss the differences between financial accounting and management accounting. First difference relates to the uses of accounting reports. That is, financial accounting provides accounting reports to both internal and external users. But management accounting provides accounting reports to the internal users alone. Second difference pertains to the type of data in which both these branches of accounting deals with. That means financial accounting is concerned with the historical data. On the other hand, management accounting is concerned with future plans and policies. Third difference says that financial accounting is concerned with the whole business and it is an end itself. On the other hand, management accounting is concerned with a specific area or segment for their analysis. There are differences from a standard setting point of view. In financial accounting, the standards are fixed by the external parties, whereas in the case of management accounting, the standards are set by the management itself. The fifth difference is related with the regulatory requirements. Financial accounting is a mandatory requirement for every public organizations by the government. But management accounting is at the discretion of the management. That means there is no mandatory requirement. Next, we can differentiate financial accounting and management accounting on the basis of duration of report. In financial accounting, financial statements are prepared for a longer period, whereas in management accounting, reports are prepared as and when required by the management. Next difference describes about the nature of the transaction. Financial accounting records those transactions which are very much accurate. On the other hand, in management accounting, appropriate figures are also used. Last difference is that financial accounting considers monetary items only. In addition to this, management accounting considers non-monetary items such as efficiency of employees, market condition, consumer behavior, etc. also. Thank you.